So the fact that we have all of these companies that have not only strong ESG ratings, but are really making strong price gains stock-wise too, what does that say to you?
Well, I think that it really makes a great deal of sense to put them together the way IBD has. And I think that it's great for two reasons. One is that when we think about high quality companies, they can be high on financial quality, but also for ESG, really what we're trying to measure is their resilience to long-term emerging risks and opportunities. So you're kind of doubling up on higher quality companies. And the second reason is that our research has shown that financial quality and ESG are actually correlated. They're not quite the same thing, but they are correlated, so at least you're going in the right direction when you combine them together this way.
Okay, so let's drill down just a little bit and talk about what goes into the ESG ratings. How are you coming up with them?
So the ESG rating is aiming to capture the resilience of companies to emerging ESG risks and opportunities relative to their industry peers. So the way to think about it is that it's a competitiveness measure really in an industry where ranking companies from the ones that are the best at managing their ESG risks to the ones that are maybe a little bit more of a laggard. So a few things to know about these ratings. The first thing is that they do range from a top of a AAA to a CCC in every single industry. Now this is not a case where we're going to give the healthcare stocks all the A ratings and the energy stocks all the C ratings. They really are actually industry relative rankings. And then beyond that, the most important thing is that these are industry specific. So that means that for every single industry, what goes into contributing to the ratings is going to differ quite a lot between one industry and another. So if you have a utilities company, what actually contributes quite a lot to the ratings might be carbon emissions, its water use. But for a food company, it would be a totally different set of financially material ESG factors that might contribute. So it would be food safety, for example, or supply chain management. And then the third thing to know is that it's really a gap analysis. What we're really trying to measure is the level of exposure that a company has to an ESG risk and how well they're managing it. And then finally, for all the different companies, regardless of their sector, we're really looking at the strength of its governance, like the corporate governance and how well aligned the management's incentives are with shareholders is a really fundamental part of a company's ESG rating.